Did you see what happened? The Fed shocked the markets, and the Fed may have just crushed the economy. In today's video, we are going to understand why ignoring the Fed is ignoring the truth. But guess what? You came here for the truth, so let me unveil that for you. I'm going to look at the details of the Federal Reserve meeting that happened that will affect everybody, even if you are not inside of the United States, and I'm going to explain why. In addition to that, I'm going to tell you who are the biggest winners and who are the biggest losers in this circumstance here today. First things first, let's talk about what happened. I want to show you, of course, directly from the source itself, from the Federal Reserve's website. You can see basically the Federal Reserve decided to keep interest rates the same. Now, you would think if that's the case, Federal Reserve leaves interest rates the same, they're not going to increase again, then the market would go up. But that didn't happen. I don't know if you could see over my head right here, but the market started to come down. As soon as Powell opened his mouth, the market started to fall. And so we have to look into deeper as to what was said. It's pretty clear the market didn't like it, all right? And what do you think? Why do you think that the Federal Reserve keeping interest rates the same, what does that signal about what's happening? Well, there's something else coming. I want to know what you think, though, about all of this. Interests on the national debt is a big concern. We'll talk more about that, but just imagine right now today where the interest is already $1 trillion, closing in on $1 trillion in interest payments. Where's that going to be if we leave interest rates at these levels? Okay, regional banks cannot handle this with SVB, all these other big banks out there, they can't do it. They can't deal with it. And of course, that means potential bank failures are going to be more common throughout 2023 into next year. The longer it stretches on for, it's not swept under the rug, it's not forgotten. In fact, it gets worse as time goes on. Let me show you something here. The Fed declines to hike, but points to rates staying higher for longer. And that really was the crushing blow that occurred because we've been told for so long, oh, the Federal Reserve is going to start cutting interest rates. This was the September meeting, which we were told earlier this year that at this point, we would get our first rate cut. Not only did they not get the first rate cut, but they signaled more would come this year in 2023 increases. Now that's a big one. All right. Projections released by the Fed showed that the central bank would hike rates to a median 5.6% by the end of 2023, up from 5.25 and 5.5. That means another rate hike. Another rate hike. Is it going to be able to handle that? Is the economy, are the markets going to handle another rate hike? Because when they increase that rate, you know that we got to then wait for the next meeting, likely unless there's an emergency, to start cutting interest rates. But what is that emergency? What was the linchpin that was pulled? What happened? Well, at this time, there's no real excuse for that, right? So I'm going to show you what indicators we got to be watching. Because if you miss that information, you miss the truth, well, then you're going to be misinformed. You're not going to make the right decisions. And so that's why I want to prepare you for that. Because you want to take this information, you want to run with it. You want to go with that. And, I have the Zoom calls I have with the mentorship group. We can get into this in real detail. But I think it's important that we look at this each and every time so that as the new information comes out, we are simply just adding to what we already know. Okay, but let's get a baseline here, and that is the Federal Reserve has increased interest rates to a level we have not seen in many, many years. This is burdening, of course, the regional banks. It's burdening all of the big corporate structure that's out there, and of course, small business too. And so, yes, the individuals, with their mortgages and everything, that's a whole different story. But when you look at it on the grand scale, where the billions and the trillions are, these things are only sustainable at super low interest rates. When you increase those interest rates, it creates a problem. It creates a big problem, in fact. And that's what I talked about in my original book, that when the day that we do have increase of interest rates, there's a huge problem underlying this whole system. Easy monetary policies, you reverse that, oh man, you create a big problem. But look how long it took to get to this point. Now, some would say that means deflation. That means everything is going to go haywire. There's going to be a meltdown of sorts. Potentially. But what comes after that? And that is the printing presses. If you think right now at this time that the Federal Reserve has done a lot of money printing, you ain't seen nothing yet. All right? I'm pretty sure there's a song written with those lines. All right? This is a good one. I worry about the economic and policy signals coming out of the Federal Reserve press conference may come across to many as both confused and confusing. Some will deem this as an inevitable consequence of this phase of inflation and policy cycles. Others will view it as further evidence of the challenging Fed communication. We don't know what to expect, of course, but it is confusing because there's mixed signals. Anybody telling you that they got 100% certainty, oh, this is the reason why, well, then they've got an issue because we don't know. You can see some strength in some areas and you see some weakness in other areas, and you kind of try to balance that out. This isn't 2017 where it was so very obvious, or let's say March 2020 where it was so very obvious. We are now in a mixed scenario. And so we've got to play this accordingly, all right? Looking at it, you could see what the dollar had done. Of course, hey, we're going to increase interest rates. We're going to be tough. US dollar goes up. This is against its peers, of course. And you look at it over a period of time. It had been fluctuating, but hey, whenever I see dollar strengthening, that's positive for somebody that's outside of the US earning US dollar. That's always a positive, let me tell you, okay? So looking at gold, just in the, over the last little while, this is always going to fluctuate, but I'm just letting you know the price as of now, 1928 by the time I record this video and get that out to you in a few hours, as well as silver being at 23. This is one thing that is going to fluctuate all the time. It doesn't represent actual real physical gold, but this is what we're dealing with. This is what we got. And what I say about gold, and I say this all the time, when all else, capital all else fails, then they turn to gold. Until then, they don't care. Okay, the physical metal, totally different. There's always going to be a shortage. There's always this demand for the physical, but the paper, whole different story. All right, so watch out. Watch how much allocation you have to precious metals. Fed estimates, this is basically talking about what we have with the interest rates on the national debt, okay? The blended interest on U.S. debt will be approximately $2 trillion, double where it is now. You got to understand here, we're increasing the amount of debt. Max, like it's going crazy. It's going crazy right now. You've seen it. 33. What happened to 33 trillion, 32 trillion? Weren't we just at 30 trillion a second ago? And now we just blow by 33 trillion? Just like that? So imagine if they keep adding to this, which they will. We know that. Oh, you want to spend money here, you want to spend money there? Yeah, throw a trillion there. I'll throw a trillion there, no problem. And imagine in the next crisis how much money they'll need to hand out left, right, and center. Okay? And so you've got this problem where they are paying all of this interest on the national debt at almost $1 trillion now, going to go to $2 trillion in the next little while. What does that do? Because they don't say, you know what? Okay, we got a crisis. We have people to help. And so we're going to help these people and we're going to stop paying the interest on the national debt. It's a matter of, national security or whatever the case, whatever excuse they make. No, they won't do anything. Okay? They're not going to help people. They're going to pay that interest. They're going to continue status quo. How does that make you feel? Let me know. Share. My comment section is not busy enough. I want to see the community grow. We're seeing that on Discord. Thank you. but I want to also see that in the comment section. All right. The central bank tried to boost financial market liquidity. The Fed is letting up to $95 billion in bonds run off its balance sheet each month. So every single month, this declines and puts more strain on the financial system because it needs this whole, artificial stimulation, and it's not getting that, and it's changing big time, right? We've seen that a lot, right? Okay, look at this. Powell indicated that while a soft landing is still possible, it should not be considered the baseline expectation. This struck fear in the market participants that we could be in for a harder landing than anticipated. And that right there was enough to give the 1-2 punch on the markets. This is important because Powell saying that was the big shock. They didn't want to hear that at all. Not at all. And yet they got that. And so here we are right now waiting the next little while. We got to wait some time for the next meeting. Up until then, there's a lot of uncertainty. And that's going to come through in the data. What are we going to get on the CPI and the PPI and the core PCE? So the inflation indicators that they give us. That's going to show some signals. What about employment numbers? Is it still strong, or are we starting to see weakness? Some of that, is positive and negative. But if you subscribe, I'm going to bring you all those details. So even before the next Fed meeting, I'll have the information that you need to know. All you got to do is tune in. Okay. So when you hit that thumbs up or subscribe, you're more likely to see these videos up in your feed. Okay. This comes out of Seeking Alpha. Basically what it's talking about is elevated rates will pressure dividend income investors. Ahead of the FOMC statement, real estate investment trusts fell into a downtrend pattern. The sector is pricing in Powell's suggestion of higher interest rates for longer than the markets expected. All right, there you go. And so we can see that. I have a big concern over the real estate investment trusts overall, the debt associated with it. Remember, I don't think people understand. They say, hey, but real estate investment, real estate is strong. Look at the real estate market. We're talking about single family homes. That's different. You got to know something here. When we talk about these big businesses, they've got so much debt. And that debt is not, a 30-year debt. It's not 30-year paper. They're getting it short term. And that means the next time they got to go back to the banks, to the lenders, they're getting it at a much higher level. So a lot of them are going to have to default. Some of it has happened already, but the concern is now growing because the Federal Reserve is saying higher for longer. If you want this article, as well as others that I've shown you, that's from Seeking Alpha. Seeking Alpha, the link is in the description. If you want to know more about that, it's on my website. Speaking of my website, everybody has to go. Everybody, don't go anywhere because that is the place to be. It's available to you for free. Compass is in there, the financial audit, all these different things are available to you for free at Compass. Compass is at themoneygps.com. I want to see you there. I want everybody to check it out. Finally brought that out, themoneygps.com. Take a look. It's right down there. Okay. At the same time, I want to highlight the comment of the day. MG, you are right about people devolving. Go to the big box stores and people are pushing their carts around, don't even look around or care if anyone is in their way. We can see that society is declining. It's devolving rapidly. And what do we got to do? Do we got to hide out in the woods, or do we try to find like-minded people? Do we try to find individuals out there who have the same ideals as us and the same behaviors as us? And believe it or not, we do exist. You're watching this video, right? But we are few and far between. And so, yes, we do experience this, but we don't give up. All right? We don't give up. And we have to understand that time is something that is not on our side. So we need to hurry up, essentially. Look, I wanted to get to this. I didn't think I was going to get a chance, but really quickly. The regional banks and commercial real estate are the weakest links, okay? Right now, there's no question about that. So watch out. Watch very carefully. That means more failures could come, and that means job losses. All right. Strong economy gives the Fed a reason to hike again. So watch those indicators. I'll bring them to you in future videos. At the same time, stocks with undeserved valuations are likely to see pain. So the ones that went up 200% for no reason, now we got to start looking at that and saying, like, it just gets more difficult as we drain liquidity out of the system. You're encountering a more difficult, let's just say, like, there's no real reason for this. And so as a result, it reverts to the mean, or at least doesn't go back to these lofty levels that some of them have seen. So that's my video for today. I hope you appreciated it. Thumbs up if you did. On the next video, we're going to break out some real cool stuff. We're going to talk about oil, all that kind of thing. I want you to check it out. So I'll see you on the next one. Take care.